I'm Matt Bouchard with NAREITWeek.com here in New York City for REITWeek 2015, NAREIT's Investor Forum. Joining me for this CEO Spotlight is Phil Hawkins, the CEO of DCT Industrial Trust. Phil, thanks so much for joining us.
Thanks for having me.
Now, DCT has a very active development program. Can you tell me what sort of activity you've had so far in 2015?
It is active, with strong demand, and I think and really strong market fundamentals. It's a great time to be building, and the risk-adjusted premiums are there in terms of returns. We've had a great run. We've delivered $280 million of assets so far that we've stabilized at an 8.25% cap rate. That's several hundred basis points higher than a cap rate that would be on those assets fully stabilized if we sold it. We have $250 million now in the pipeline. Leasing is going very well. Returns we're expecting to be 7.25%. Again, well above cap rates would be if we sold them. So again, a lot of value creation. And we also, given the leasing on that pipeline and a few projects where we have pre-leasing going on, we've now said 200 to 300 million of new starts this year. So pretty active, successful in terms of what we finished, and really good leasing on what is in place right now.
DCT delivered sector-leading same-store growth in the first quarter of 2015. To what do you attribute that growth, and how can the company keep that momentum?
Well, back to development, it's a very good time to be in the business. Strong tenant demand, growing rents, occupancy levels that are rising. It's a good time to be in the business. So the market is very helpful. We've got a good portfolio. We've spent a lot of time upgrading that portfolio over the last 5 years. We've I think made some great acquisitions with strong growth prospects. What we've sold, I think, has been assets that we felt were lower growth. And then lastly, besides the portfolio and the market, I'd say people. Very focused on operating the portfolio, leasing and management, pushing rents where we can, retaining customers where possible, but also being aware that losing that customer and replacing them with a higher paying customer is possible. It's just, so I think people, portfolio, and market all have contributed. I don't think we'll sustain 10.9% growth. In fact, I know we won't. But I think I have a very positive outlook for the next several years. Again, as healthy demand, supply that remains in check, and rents that will continue to, I think, move forward.
So with that positive outlook, give us one story that investors should be looking at in the industrial sector for the second half.
I think, and the talk already at NAREIT here, is the seemingly unlimited appetite of private capital for industrial, all sizes, headlined by sovereign wealth funds and large institutional investors that really have a strong desire to invest in industrial. And as a result, pricing, both even for smaller assets, but certainly large portfolios in the private market, are cap rates on those portfolios are lower than the implied cap rates on where publicly traded industrial REITs are trading. And how that gap gets narrowed or eliminated will be, I think, pretty interesting. My personal belief is that there is a lot of confidence by private institutions in industrial and a lot of capital that I think it's less likely that private pricing comes back than hopefully public market pricing goes up, as I think public REIT investors understand where values really are. So we'll see how it goes. And I think that will be a key story for the rest of 15 and probably into 16.
Great. Well, Phil, thank you so much for joining us.
Thanks.
For more on this and other REIT news and analysis, be sure to visit REIT.com.